Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world. Hello there. We did it, somehow. The rankings white paper. I've been teasing about it on the pod here for the better part of 6 months, but we finally completed it, and it is being released alongside this pod. Sort of my baby, a ranking methodology I came up with years ago, which tries to measure all the different aspects of a track record important to investors. Some investors look for the best return, some for the best Sharpe, others for the best MAR, others just for the lowest drawdown. We show best by all of those and then combine them into an overall ranking. So it's kind of fun, it's kind of interesting. So jump over to rcmalts.com/rankings to download the rankings. After you do that, go subscribe to the pod if you haven't already, because we have Macro Alf coming on next week to dish on the banking crisis, inverted yield curve, if the Fed is trapped, and all the macro nonsense you could want. It's going to be fun. Okay, that brings us to today's episode, where we have Kapil Rastogi of PlusPlus Capital, which happens to be in our best by risk control listing in the white paper we mentioned, which we're going to be doing over the next couple of weeks here of trying to get as many of those top ranked managers on as possible. I wasn't quite ready for him to say the secret sauce is culture, but that's where we went. He's also got some quant stuff in there that helps with that risk control, but it was an interesting chat. Kapil also talks through the pitfalls of backtesting and overfitting, why he chose behavioral-based signals over trend, and what questions investors should be asking, but don't. Send it. All right, everybody, we've got Kapil, and I'm not going to try and pronounce his last name. I'm going to let him do it for us. Kapil, how do I say your last name?
Rastogi.
Rastogi, just like it's spelled, easy enough. So Kapil is here with us. I think you're in Princeton, New Jersey, right?
That's correct. Yep.
Is everyone all pumped up over the 2 wins in the tourney?
Oh, absolutely. It's huge.
Yeah.
Hopefully let's pray they can keep it going, right?
Right. I can't remember who they have next round, but it's not a huge seed, right? They could keep going.
Yeah. Let's hope, right?
Let's hope. And later on, I think you've got some parallels with sports and your investment style. So we'll get into that in a bit. But we've had Roy Neiderhoffer here on the pod, dishing some gems. And so you used to work with Roy and at Neiderhoffer, right? So give us a little bit of the background, how you got into there, when and why you left, and what you're doing now.
Yeah, definitely. So my background. So I graduated from MIT in 2002 and with a degree in math with computer science. I after that I started working at Merrill Lynch Investment Management out in Princeton, right? That's where the world headquarters were back in 2002 before they merged with BlackRock. I quickly realized that risk management, it's a great place, but I had a real passion for markets, and I wasn't really getting any market exposure. So I started interviewing at different hedge funds, and I got a job at Roy's firm. A wonderful place to work, that's for sure. I started at kind of at the bottom of the totem pole, being a European execution trader, so right at the very bottom. So my hours, my glorious hours were 1 a.m. to, I usually leave it around 1 p.m. or 2 p.m. Eastern Standard Time. So, nice. Yeah, I mean, and I did it because look, it was an opportunity, and I knew this is what I wanted in the long run and for myself.
Quick side note, Mike Harris of now at Quest and formerly president of Campbell and president of the MFA started as a European desk guy. So for all you young listeners out there who want to get into the industry, go beg and plead at a hedge fund to say you'll work the overnight hours.
Absolutely. I think it was a wonderful experience. Obviously not great for my social life, but hey, it's, one thing I talk about a lot is like, if you want something badly enough, you have to sacrifice a lot to achieve it, right? That's a universal rule of life. So,
were you up there in Vermont or New Hampshire, or wherever he is?
No,
he was in the city at the time.
He was in Manhattan.
Got it. Okay. Yeah.
So I did that for about 2 years. And then I came back on the New York shift. And kind of, the interesting anecdote is, for the first 2 years, Jeff, I started trying to develop strategies, and like pretty much every strategy I tested failed miserably. It was just a colossal failure. And the one thing I tell, I do guest speaking to at different universities. including Princeton, which is in my neck of the woods. And one thing I tell people, a lot of young individuals that want to break into our field is, look, for the first 2 years, like almost every strategy I back tested didn't work. And when I finally did get one that worked with statistical significance, we put into live trading.
And it didn't.
And you know what happened is that it just lost money, and lost money.
Yeah, I was going to say the back testing is the easy part. The live trading is even the harder part, but you got it. So you were even struggling in the beginning on the back testing part.
Oh, absolutely. I mean, and finally, when I got the back test to work, the live trading part, hey, I can't tell you what it feels like to just kind of watch your strategy just kind of bleed money in live trading.
I've been
right?
there. Yeah.
And so, and again, it all boils down to perseverance, right? I mean, I've done, I don't know how many back tests in my career, definitely, tens, if not hundreds of thousands. But I think, after a few thousand back tests, I think it slowly starts clicking as to kind of like, what works in the back test and what'll actually work in the live trading and how to normalize those two. Look, that just comes through just sheer perseverance and willpower and just saying, hey, look, I'm not going to give up, because there's no book to teach you how to do this. That's for sure. There's no training, really.
Yeah.
You just have to kind of like, grind it out. And I played competitive sports my whole life. So I had that mentality. So I just kind of went after it. And ultimately, yeah, I mean, the first couple of years, it was really tough. Definitely probably the most difficult years of my life, to say the least.
And while you're sitting in at Neiderhoffer doing these, were they like, we got to fire this guy, he can't even make a good back test?
No, nothing like that. I mean,
Yeah.
he wasn't really like that ever. He gives people space. I was very young, right?
Yeah.
So it's nothing like that.
And what sports were you playing?
In college, I was on the rowing team.
Oh,
I
nice.
was a college rower. In high school, I played a variety of sports. I played soccer, I played volleyball.
Right there on the Charles River?
Yes,
At the,
absolutely.
what's the big event they have, the regatta?
Head of the Charles.
Head of the Charles. Never been. It seems like a good time.
Oh, you got to check it out. I mean,
All right.
yeah,
Put
it's
it
a
on the
great
list.
sport. Yeah. I mean, rowing is a great sport to just teach you just grit. And conversely, the only people that do it are a little bit masochistic, right? But also, really, you just have to push through the pain. And so that analogy worked well in the hedge fund space, because again, when it comes to back testing, look, you just have to kind of just, keep trying things over and over and over and over again. And eventually you'll kind of figure out, okay, well, oh, this is what actually works in live trading, right? So, yep.
Yeah, just okay. So then you're at Neiderhoffer and you decide somewhere along the way to go off on your own.
Yes. So the way that worked out, Jeff, was in around 2006, I met my nail partner, Murat Unlur. So he was the head of software development. I was kind of building a whole bunch of quant strategies, and slowly, more and more of the portfolio was being kind of allocated to the quant strategies that I developed. I still remember for the first, I started kind of doing more marketing, just because I knew the models pretty well. So I started kind of getting roped into marketing a little bit. And for the first time, I saw a peer group analysis of CTAs.
You mean talking to investors, basically? Yeah.
Well, I wasn't really talking to investors too much, but I was doing some analysis behind the scenes, right? Like helping the marketing team look at correlations, how are we different, trade examples, right? That's a big thing. For the first time ever, I was kind of doing some marketing, which I'd never done before, right? I was just really kind of focused on building strategies with the highest risk-adjusted return possible. So for the first time, I look at our peer group. I had no idea who these firms even were, right? We're talking about household names now, like Crable, for example. I remember looking at the risk-adjusted returns, and the first thing I said to myself was, you know what? If I went out on my own, I know that I could produce a higher risk-adjusted return than what I see. And I knew it would be a long process. I knew it would be a struggle, but I knew that was the first thing that popped out at me. Now, the second thing that popped out at me was that, wow, what we're doing, which is behavioral biases, it's different. There was one or two other firms that were doing something kind of similar, a little bit, but not really, And so I said to myself, okay, well, you know what? If I could go out on my own and do things which I believe to be, the right or optimal way of doing things, and everyone has their own perspective on this, right?
Mm-hmm.
About how to build a business. I said to myself, look, I firmly believe that we could be the best in the world. We could be the best CTA out there. And I still, firmly believe that. And, obviously the results are the results, right?
You can't go for it without believing that, right?
Yeah. And so that's where it really started. So I had a talk with my business partner over kind of a happy hour. And, I saw that he had a similar kind of vision as I did, which is really to be the best of what we do, right? I mean, that's really what it boils down to. Having that mindset of, okay, well, we want to be number one, and that's our definition of success. Everyone defines success differently, right? For me, in our firm, success means being number one meaning that, like, having the highest risk-adjusted return in the space.
Getting into this with Marty Bergen last week of like, is a lot of trend followers, their track records are so long that all their warts are there for the world to see. So almost by definition, they're going to have lower risk-adjusted returns than the newer flavors of hedge fund or even in their own strategy. So a little bit of it is just time and the window that you're looking at. But I think you would feel, even if you had been around longer in those years, you're saying like, no, the way we do it would produce a better risk-adjusted return.
Yeah, I mean, look, Jeff, you bring up a valid point, right? I mean, obviously, look, you have to have a sufficient time period to evaluate a track record, right? Now, in our case, our track record is 5 years, right? So if you look at our 5-year track record, right, with the model we have called PlusPlus Global Alpha, I'm very proud to say that what we set out to achieve, which is the strongest risk-adjusted return in the CTA space, we've accomplished. So we have the highest Sortino ratio of all CTAs in the SocGen CTA and SocGen STTI indices, right? So what we set out to achieve way back, in 2007, that vision that we had, thus far, I'm very proud to say, has come to fruition, right? And it's been quite a journey. My partner and I, we spent several years building our own backtesting platform, right? Easily put in over 10,000 hours just in the backtesting platform alone. People always ask me, well, why do you spend so long, building a backtesting platform? You can purchase one off the shelf. What's so special about your backtesting platform? One thing I tell people is like, look, I mean, at the end of the day, we're running a business, right? And so in a business, you have to have a competitive advantage. Moreover, you have to have a long-term sustainable competitive advantage if you want to be the best at what you do. And so one thing I quickly realized is that in the quant trading space or systematic space, you can have the most brilliant idea in the entire world. But you know what, Jeff? If you can't backtest that brilliant idea, it is totally useless.
Yeah. Or I would even correct it for you a little bit. If you can't realistically backtest it.
Exactly. That's what I was going to say.
Yeah.
The reality of the world is that if you can't backtest that idea quickly, it is effectively garbage, right? So, building your own backtesting structure from scratch, which allows you to backtest ideas very quickly, which other people can't test quickly, that's definitely a massive competitive advantage, which is sustainable. Right.
Yeah.
And this is where the business culture all comes in the sense that, if it takes me several years to backtest an idea, which I think is really good, I'm going to do it. But if you're at, let's say, a really large firm, where the incentives are just a little bit different, right? I mean, you have a year-end bonus, right? I mean, you're not really, going to pursue an idea which only produces results after 3 years.
Similar to our U.S. political system, right?
Yeah. Right. I mean,
nobody wants to plant trees. They just want to harvest them right now. Yeah.
Right. I mean, and also it's the compensation structure, right? I mean, you're getting paid based on the respective results you generate, to some extent, right? You're not getting paid just to kind of like, do back testing, right? I mean,
but the same is true for you, right? As a business, you can't get paid to sit there and back test and not produce any results for 5 years. You'd go out of business. You'd have no clients.
Oh, absolutely. And that's the reason why very early on, this is way back from 2010 to 2012. we spent several years kind of building our back testing structure, knowing that, look, this is going to give us a real sustainable.
Like before you had client assets, or in conjunction with your launch, essentially?
Yeah, before we had real client assets is when we kind of really sat down and kind of just coded 6 days a week.
And what's that look like? So in my mind, when I hear that, I'm like, oh, you're doing higher frequency stuff that needs to be done really quickly, and that loses its edge over time, when kind of, I would argue, more traditional managed futures is kind of like, hey, it's a core piece of the market that works, trend following works, kind of regardless of what you put it on. Maybe not on a risk adjusted basis, but on a pure what you're looking for, it works, quote unquote. So I don't necessarily need to back test it quickly. So explain those two pieces of, like, why does it have to happen quickly?
So why did the back testing have to occur quickly?
Yeah. Because it seems like you're saying, like, because you'll lose your edge, right? And if you don't get in there quickly, other people will find it and you won't have the edge anymore.
Not so much, really. I mean,
okay.
The inefficiency that we recognize in our portfolio, they last for quite a while. But the reason why, Jeff, they last for quite a while is because they're difficult to find.
Yeah.
Right. So there has to be a barrier to entry, right? Which is high enough that it's very difficult for people to get in. So when it comes to a lot of the behavioral inefficiencies which we implement in our portfolio, they're very difficult to find, first of all, because behavioral biases in the markets or inefficiencies. There's people like Daniel Kahneman, which have done great work on it.
Mm-hmm.
But the reality is, like, in order to find a behavioral inefficiency which you can exploit, you had to have been watching the markets for years upon years. And, like, if you watch it for long enough, you develop good intuition, just like in any other field, right?
Mm-hmm.
Like, if you've done 1,000 surgeries, you'll experience leads to better judgment and better intuition. So in our space, in my case, again, as I said, like, I was a quant, but for the first couple of years, I mean, all the strategies I tested, nothing worked, right? And it's only after tens, maybe hundreds of thousands of back tests did I really kind of get in the rhythm of kind of finding strategies that work in the back test, and most importantly, also make money in live trading. And then furthermore, being able to take a multiplier and say, hey, look, you know what? If my back test has a risk-adjusted return X, I know that in live trading, it'll produce, 0.75X.
Right.
Right. That just takes a considerable amount of time.
I guess my question is, you could have, in theory, come up with a very simple trend following model that worked, right? You write your first back test using an 80-day look back and a 2 standard deviation breakout model would, quote unquote, work in the back test, right?
Right.
Especially if you add more markets and look back further. So what drove you to be like, hey, I don't want to go down that more simple model. Like, basically, I want to do these more complex behavioral models. And we might have buried the lead a little bit of, like, if we back up and say, what is PlusPlus doing at the top, top down, looking down level with these behavioral biases? So I don't know if there's a question in there, but you know what I'm saying? Give us the top down view so we can level set, and then let's dig into why'd you choose to go that path instead of the more simple path?
Yeah, definitely. So look, the name PlusPlus, right? That really signifies kind of our everything we do. The first plus have the strongest risk-adjusted return in the space. That's the first plus. And we came up with that name, Jeff, before we started trading. Right? So you can see our objective, our vision statement, it's embedded in our name, right? So 2 pluses. First plus, strongest risk-adjusted return in the space. Second plus, low correlation with everyone else in our space, and obviously all the major indices, right? So that's our value proposition. That's what we do. That's our competitive advantage, and that's the value add to an investor. Now, to answer your question very succinctly, look, if I just did a simple trend following model, we would not honor the first plus, which is being the best at what we do, right? And that's kind of, it's a reflection of kind of who we are as people, right? Trading to a large extent has to be a reflection of kind of who you are, right? Because you can't trade with a style you're not comfortable with. For me, from day one, we were always about kind of being the best. So if you want to be the best, then you have to be different from everyone else, just by definition. Hence the reason why we built our own infrastructure, which took us so long to build. And we continue to add on. And secondly, the behavioral approach, it really is different. That's for sure. And I'm a firm believer that it will continue to be different, even as more quants enter the space, because you really need just many, many, many years of watching markets before you can really come up with a really good short-term strategy based on behavioral biases.
And so what bucket would you put yourself in? You're probably going to say I'm outside of the categorization of the buckets, but if you were forced to, short-term trader, trend follower, pure absolute return, no correlation, any of those buckets, what would you say?
I would say if I had to classify ourselves into one of the three, which I guess you're forcing me to, I have to classify myself. I would put myself in the short-term bucket. Why? Because our average holding length is 4.5 days, so clearly we're short-term.
Yeah, and you do exhibit some correlation to managed futures as a whole and trend following, correct?
We do. Our correlation to, for example, the SocGen STTI index is a little bit over 0.2. As to whether you consider that material or not,
that's a whole other pod. Yeah.
Right.
Yeah.
Our correlation to trend following is zero. Our correlation with the S&P is slightly negative.
And then, so can you give us a few examples of these behavioral trades without giving away the secret sauce? Yeah.
Sure. I can give some examples. One of the things we definitely look at is we look at so I'll give you one really good example I like to use is December 6th, 2019, right? The buy the dip trade in the S&P qualifies. Okay, buy the dip trading meaning that the market's going straight up and then there's a big dip.
Yeah.
And then whoever bought the dip on that day, over the next 4 or 5 weeks, you would have made about a 5 or 6% return.
It became so good it got called buy the fucking dip, right? BTFD, not just BTD.
Yeah. So December 6, 2019, buy the dip trade in S&P works fabulously well. You make about 5% in 3 weeks, right? About less than a month later, the buy the dip trade again qualifies. If you put that trade on, again, you would have made about 5% in 3 weeks, right? Buy the dip trade again, late February, right? 2020, right? Buy the dip trade again qualifies.
Mm-hmm.
Okay, let's take a step back, right? You're that investor, Jeff, right? First buy the dip trade, you made a lot of money, right? Second buy the dip trade, you know what? You made a lot of money. Third buy the dip trade, what are you going to do? Right? Human nature.
I'm an outlier. I'd start taking it off the table, but I know you're going. Like most people at that craps table, they're pushing the 6, right? Like, okay, it just hit. Put more on.
Exactly. You put more on. Now, imagine, Jeff, for a second, you're that person. You know what? You missed the first buy the dip trade. And you had to watch that market go straight up. And you missed the second buy the dip trade. Right?
I definitely missed both those, yeah.
Right? And then the third buy the dip trade, well, what are you going to do?
Yeah, get in.
Get in. And not only will you get in, Jeff, you will get in with some real size, right? Because you're going to say to yourself, hey, you know what? I missed the first buy the dip trade. I missed the second buy the dip trade. Both those trades made a lot of money. There's no way I'm missing the third buy the dip trade, right? So you're going to get in and you're going to get in with size. Okay, so our models, for example, will sell that third dip, right? You see that?
Yeah.
So that's an example of something that we do, right? And then so you take this phenomenon, you codify it into a set of rules
based on because it's the third, or based on a whole bunch of other.
No, based on the fact that it's the third, right?
Yeah.
Right. I just want you to understand the behavioral thinking behind it, right? So this is the concept, right? You have to codify into a set of rules, back test it across all the markets that we trade. I'm giving you an example in the S&Ps, but look, we treat all the markets more or less the same, right? Why do these behavioral biases work? Why do these behavioral theses work? It's because markets consist of people, and people are predictably irrational, right? That's why it works. So we take a behavioral thesis like this, and we back test it across all the markets we trade, right? And then we look at how it does in aggregate across all markets. We say, is it statistically significant? If the answer is yes, then we test it out of sample. Is it statistically significant out of sample? If the answer to that question is yes, then we just say to ourselves, hey, look, we have some real alpha here. right? So you can also see, Jeff, how our approach naturally leads to uncorrelated returns. Because if you think about this strategy, this idea I just mentioned, it's not going to be correlated with trend following.
Yeah.
Right? Is it going to be correlated with S&P? No. If anything, it'll be slightly negatively correlated, right? Because we know when the S&P goes down, vol goes up.
How do you avoid the trap of, hey, every third Thursday the yen goes down? And is that just coincidental, or is it right every March 17th of every year, because it's close to St. Patty's Day, something happens, right? Like, do you check it against fundamental anything, or if it's held statistical significance, it's in the portfolio?
No. So, okay. So what you're referring to, Jeff, is how do we avoid overfitting?
Yeah.
Great question. Okay. So the way we tackle that problem is we have a thesis and we test that thesis across all markets. Okay. So if you think about it, using the example you used, buy yen on March 17th because it's St. Patty's Day, that's just the yen. So we would never trade that, right? Now, if you're saying the thesis is, hey, look, let's buy all the currencies or all 62 markets on March 17th because of St. Patty's Days, great, let's backtest it. And I can already tell you the results will look terrible.
Yeah, right.
Right? Now, you see how, Jeff, what you described is very common. Where like you have an idea, which it just works on one market, right? Why does it work on that one market? Why doesn't it work on CAD? Why doesn't it work on Aussie dollar? What's so special about the yen? And the reality is, Jeff, there's nothing special about the yen.
Right.
It's just
They're
pure
all
overfitting.
tradable widgets. And so what does that portfolio look like? 20 markets, 50 markets, 100 markets?
62.
62. So in all the normal kind of managed futures buckets, grains, energies.
Yeah, the four sectors, right? Fixed income, currencies, commodities, and equities.
Got it. And then I just jotted this down. Let's dive into it now if you want. Like, right, you keep saying intuition, the 10,000 hours rule, all that stuff. Some would argue like, hey, we can shortcut that process with AI, right? We can run this all through AI. We can get AI to identify these patterns much more quickly, much more whatever. Like just and they can run many, many more iterations than you can do.
Right.
What are your thoughts? Do you guys use that? Do you have thoughts on whether that's good, bad, indifferent?
That's a different approach altogether. It's hard to say good or bad. Look, good or bad is just dictated by the results, right? Hey, look, if you can generate great risk-adjusted returns in live trading, hey, all the power to you, right? Yeah. I can share with you my opinion. With AI it's a good tool, but it doesn't replace intuition. There's no way, right? Look, if you give me 1 million different back tests, just again, being a math person, right? Take a 1% confidence interval, right? There's a certain percentage of them that will be significant just purely due to chance.
Yeah.
Right?
But that's what I'm saying. Like, why not tap into that and get like, hey, we've got 50 more just due to chance that are now significant that we could put into the portfolio.
Yeah, I would never do that. It's just not our style. Behind every strategy, there has to be a real clear thesis, which is based on intuition. So what I shared with you, Jeff, about the third dip, there's clear intuition behind that. And that's intuition. Look, it makes sense to me. It may not make sense to someone else, and that's okay too, right? But that's where the judgment and experience come in. What happens with like what you described is like you'll have all these different statistically significant strategies. The thesis makes no sense to me, right? So the thesis has to make sense to me as a portfolio manager.
But some don't even have a thesis, right? They're complete black box AI and just shooting out signals, right?
Yeah, for me, that's very dangerous.
Which I've told some of the guys, like, have the AI also produce a thesis, even if it's totally unlinked from the actual signal. Just be like,
that's where human beings come in, right? In terms of like pattern recognition and developing a thesis, right? If you can develop the thesis and then get the computer to basically test the thesis, that's something a computer is very good at. If you're asking a computer to like come up with a thesis, I don't think that's a wise idea at all. I mean,
Yeah, it was
they're
mainly a joke of like, hey, you have trouble explaining this to investors, have the AI just create an explanation, right? Like the
yeah,
signal's totally random and you can't explain it. So why not just explain it away with some other totally random thing?
right.
That's a little bit tongue in cheek. So talk about this. So this seems to tie in with like, we were talking a little bit off screen of like culture versus strategy, right? So
Yeah.
anyone can create a strategy. You could use AI to create it. You could have experience in the bank and know what works, yada, yada, yada. So talk to us about what you mean about like, you have to have the culture. I kind of took it as infrastructure, but whatever. Tell us what you mean by culture versus strategy.
Yeah, definitely. So this is a big part of what we do is I can share with you that there's a management guru called Peter Drucker. I don't know if you've heard of him,
Yeah.
but he has a very famous quote which I like, which is he says, "Culture trumps strategy in the long run, always." And then he has another quote which he goes even further, and he says, "Culture eats strategy for breakfast." Right? Very
Yeah.
strong words.
Very.
And he's referring to just business in general. Okay. And this is something that, having played competitive sports my whole life, it immediately resonates with me. Like any competitive athlete, like you don't have to tell them this, right? The importance of culture. Look, if you look at all the best sports teams in the world, New York Yankees, New Zealand All Blacks, right? Real Madrid, right? They have certain things in common. Number one is always culture. Always, always, always. Okay, so how does this apply to our space, right?
And just March Madness, perfect, right? The cohesive team that believes in each other, believes in the coach, usually wins over the super talented team that is barely has a culture.
Yeah, I mean, look, you talk about basketball, right? 2004 Dream Team, right? I don't know if you remember this, U.S. Olympic basketball team,
Yeah.
full of superstars. How can you lose? But guess what happened? First game, they lose to Puerto Rico by 19 points. Puerto Rico.
Yeah.
What stars are on that team? How does that happen? Look, culture, 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 right? It makes such a big difference in any business, in any team endeavor. Now, so let's talk about how it applies to our space, right? Because everyone will agree that culture is important. The California Management Review, it's kind of a lesser known business review, which only kind of like geeks like me read.
Yeah.
In I believe it was 2002, they did a great study where they said, okay, look, what Silicon Valley firms make it and which ones don't. Silicon Valley, like our space, is hyper competitive, right? So over 10 years, they tracked all these startups. And they said from day one, okay, we're going to divide up all these firms into 5 cultures. Okay. Culture number 1 is commitment culture. Culture number 2, is star culture. Culture number 3 is bureaucratic culture. Culture number 4 is engineering culture. And then finally, autocratic culture. So let me quickly give you a description. What is commitment culture? Commitment culture means as a leader, you're actually looking out for the long-term interests of your employees, okay? And most importantly, all the employees know this, right? So again, you're looking out for the long-term interests of your employees, and your employees can see this. So in essence, you're committed to their long-term success, right?
In preference to the shareholders or in conjunction with? Yeah.
In conjunction with, right?
Okay. Yeah.
Okay, then there's star culture. What is star culture? Star culture means, look, you produce something for me and I pay you a lot of money. That's star culture. That's very prevalent on Wall Street, also in Silicon Valley, right? Culture number 3, bureaucratic culture, doesn't exist as much anymore, in my opinion. It's basically, look, we have job descriptions, project descriptions, and strong project management. That's bureaucratic culture. Then engineering culture, okay, we have an open atmosphere, basically free of any constraints, have fun, right?
Yeah.
And then finally, autocratic culture, hey, look, you come into work and you get paid. Now, interesting thing is, Jeff, which culture do you think over the 10 years was the most successful? Like of all those Silicon Valley firms, startups, right, they're classified into one of these 5 categories from day one. 10 years later, the results were astounding. Which culture by and far do you think achieved the best results?
Well, I'm going to go commitment culture.
Yeah, exactly.
Yeah.
Now, not only did commitment culture succeed, and get this, in the hyper competitive world of Silicon Valley startups, not a single startup failed that employed commitment culture from day one over the 10 years. Not a single one of them failed, which is, in my mind, just astounding.
Yeah.
Right? Now, what's the parallel to the hedge fund space? Well, there's many parallels, right? So one thing I always talk to people about is I say, look, superstar culture doesn't achieve the greatest of results. But you know what? That's what's most common, right? So look, there's an inefficiency right away, right there. Is as an investor, it's all about asking the right questions. What good investing is all about is asking good questions. So if you can ascertain what kind of culture is prevalent at the hedge fund, well, automatically that's a very valuable nugget of information because we know that commitment culture produces the best long-term results. So now, how do you know if a firm has commitment culture or superstar culture or engineering culture? So here's some basic guidelines: is look in hedge funds that have been in business for a long time. Question number one is, how many successful traders have you produced? How many of your traders have started their own hedge funds? Successfully, unsuccessfully? How many of your employees have gone on to be successful, quote unquote? Right? Now, if you think about it, if the hedge fund hasn't produced anyone that successfully created their own hedge funds, okay, that's a red flag immediately. Why? Well, there's only two possibilities, right? Well, why would a hedge fund over a long period of time not produce anyone that successfully went on to start their own hedge fund? There's only two explanations. Explanation one, there's not many opportunities for growth within that firm, which results in all the employees at the firm just leaving.
Yeah.
Right? So in all my years in hedge funds, and I worked at, two multi-billion-dollar firms, every single employee I met at my hedge funds, okay, one thing they had all in common, Jeff, was all of them had an aspiration, a dream to eventually start their own hedge fund. There is no employee at a hedge fund that goes into the hedge fund and says, okay, I want to be an employee my whole life. That does not happen in the hedge fund space, from my experience.
Well, even in the back office and roles like that, for sure, right?
That's a good point. I'm referring more to the research.
Research trading. Yeah.
You will never. I've never ever seen a single person who is in the research or trading group at a hedge fund that does not have a dream to eventually start their own hedge fund, right? So if nobody at a hedge fund has ever successfully started their own hedge fund, right, it's a red flag in my view. Why? Because there's only two possibilities. Possibility one is there's not many opportunities for growth within that firm, meaning that the leader is not providing enough opportunities or any opportunities at all for people within the firm to eventually start their own fund. And if people within the firm see that, hey, look, there's zero possibility of me starting my own firm, if I stay here, then everyone's eventually going to leave. It's going to lead to high attrition. And business literature all says, this is just common sense in my view, is that high attrition or a lot of people leaving eventually leads to poor results. And in our firm, that means big drawdowns.
Yeah.
Right?
But all right, I'll let you go ahead. But to me, it's like, how do you separate the strategy can be solid, right? It's not necessarily going to lead to bad results.
That's a good point. So there's two components of success, right? There's a strategy and there's culture. Okay, when you're evaluating, let's say, a business like a hedge fund, there's two components, right? There's strategy and there's culture. Evaluating the strategy and evaluating the pros and cons and the approach of the strategy, that's something that which you basically just did, right? In a very primitive form. You're asking me questions about the model building, asking me for an example, etc. And that's something that, look, we're all trained to do that. There's training as an investment analyst, and how do you evaluate a hedge fund strategy, right? Now, culture, that's much harder to evaluate. Like, how do you evaluate the culture within that firm? In my opinion, I think that's really part of the secret sauce, right? As to what hedge funds make it and which ones don't make it, right? It's more than just a strategy, that's for sure. We all know that, right? But culture is a very critical long-term component of success.
Yeah, but I
right?
guess I don't. Why is it more important, right? I guess I would view the strategy could overcome any cultural issues, right? That if you have a strong enough strategy, it's going to produce returns no matter, say you have, right, a jerk at the top who just has the best strategy and he's winning. You have a bad team, but the strategy keeps producing results. So what's that why of like, how does the culture leak into the strategy? A
Oh,
bad
okay.
culture. Yeah.
Yeah, definitely. Look, a bad culture eventually leads to attrition, people leaving.
Got it.
Lots of people start leaving. Just like, you're at RCM, right? Like if you happen to leave for whatever reason, well, your responsibilities have to be passed on to someone else, right, Jeff? Now, for you to pass on your responsibility to someone else, if you've been there for a long time, you can't pass it off in 2 weeks. It's impossible. How would you pass it off in 2 weeks, right? So a lot of things will be lost, right? And now you have to find new employees, right? Now imagine your firm's going through a drawdown, Jeff. Finding new employees when you're in a drawdown, good luck with that.
Good luck. But I guess the strategy is still going to be right. So it's about the next step after that, right? Of like, fine, we couldn't get the new employees. Now we're not doing the new research. Now we're not doing the new project of the execution improvement, whatever, right? So it's those little pieces that get washed
They all
away,
get
sort of.
lost.
Yeah.
Oh, absolutely. All the details get lost. And honestly, being successful, it's really all about getting the details right. Right? It really is. I mean, yeah, I mean, look, first of all,
But that seems like it would lead towards the process culture, right? What was that one called?
Bureaucratic or
Yeah,
autocratic.
it seems like, okay, we got to get all the details right. Let's make sure we're a bureaucratic culture.
Well, I mean, look, getting the details right. I'm talking about the strategy now.
Yeah.
That's important anywhere you go, right? So again, look, if I create a model, okay, it has a whole bunch of parameters. There's nuances to it. The intuition, again, my intuition is going to be different than your intuition. Maybe sell the third dip makes no sense to you at all. That's fine. But if I leave, then you know what? Then all of a sudden you have a strategy now with no strategy owner attached to it. Why is that dangerous? One can argue in the short term, there's no real danger. It's still running, as you said.
Yeah.
Right. In the long run, there's huge danger. Right. Who knows? The parameters are set the way they are. Why the third dip? Why not the sixth dip? Why not the second dip? Why the dip altogether? Why'd you quantify a dip the way you did? You know what I mean? So in the long run, it really is dangerous. That's for sure. So that's where really the culture eventually leaks into the strategy. That's for sure. Because look, at the end of the day, Jeff, a firm is composed of people, and the models are built by people. They're built by humans.
Yeah.
Right.
I think that's what some investors like. They think they're just buying this track record that exists through time, but really you're buying the firm, their ability to innovate, their ability to research, right, and produce new alpha over the years as things change.
Right. And look, Jeff, just going back to business literature again, 90% of the alpha is created by 10% of the people. Always, 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 always. If that 10% is not there anymore, as an investor, you want to know that.
I thought it was an 80-20 rule. It's a 90-10 rule.
Okay,
somewhere in there. Yeah.
Yeah, somewhere in between, right? I mean, you get the overarching idea, right? So when we talk about investing in track record, look, I totally agree with that. But hey, you better be sure that track record is repeatable.
Right.
Right.
And dynamic to some extent of like, what if, which we've
Yeah,
seen.
I mean, look, if you look at, for example, look, let's take something like paleontology. Okay, why did the dinosaurs go extinct? Why? Because they couldn't adapt. Right. The ability to adapt and adjust is one of the key predictors of long-term success in any field, right? And again, the CEO of Goldman Sachs, Henry Paulson, said it himself. Look, he got a lot of heat for this, but he said, look, pretty much the vast majority of our alpha or our results are really being generated, as you said, by 20% of the people.
Yeah.
Right. He got a lot of heat. That's always the way it works. It's just kind of, again, a management maxim. You'll see that at any company you go to, you'll see that. So as an investor, hey, you want to make sure that whoever that 20% is or 10% is, are they still there?
Right.
Right.
Yeah. And we'll move on. But yeah, in my mind, there's still that piece of like, well, it doesn't, right? And I've heard it argued of like, yeah, no, they're not there, but it doesn't matter because it's systematized and the processes are all documented and we know how to do. Right. We've got that all documented. So it doesn't really matter if that person's there or not.
Fair enough. Yeah, I mean,
Yeah.
look, we can debate it all day. I think, like, look, the whole concept of idea generation. Look, in terms of generating ideas, that's why you need human beings.
Yeah. No, I like it because a lot of times you just hear people or other firms say, no, we have a robust research process and we're always looking to innovate, but it's rarely talked about is here's what we believe in terms of culture and making sure the people we need to be here are succeeding. But it also is interesting to me if you have that commitment culture and you're saying we want to train them well enough that they can go start their own fund and they leave, right? Aren't you in the same spot? Like if you had the bad culture and they leave, you have the good culture and you've trained them well enough to leave.
Yeah.
You kind of end up in the same spot that they left.
That's a good point, Jeff. You do.
Yeah.
Look, we have commitment culture at our firm, right? And it's something that I implemented from day one. And both my partner and I were completely on board with it. Look, we've known each other since 2006. We're working together through ups and downs. Now, look, here, I'll give an analogy, right? If you have a tree or plant in your office and it keeps growing, 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 eventually hit the ceiling, but then it won't stop growing. It's going to start growing. Oh, it's going to start growing laterally across the ceiling. Okay. So this is just a law of nature, right? Human beings were designed for growth. So look, people are going to leave, whether you like it or not, to start their own funds if they have talent.
Yeah.
Right. If they don't have talent, okay, well, they probably won't leave then and they'll do something else. But if they do have talent, whether you like it or not, Jeff, they're going to leave. And you know what? That's very natural. It's very normal for any living organism to want to grow.
Yeah.
Right. So brings me to my second point is, when it comes to kind of culture is, if nobody's kind of started their own kind of respective hedge fund, then the other question, as an investor, I would ask is definitely, how are you not kind of producing, or you're not hiring good people?
Right.
Right.
Talented people.
What is your hiring process? And that's a very important question to understand. Like, are you hiring lackluster, subpar individuals that are really not capable of performing at the highest level? And again, these are just questions, I mean, and again, investing is all about asking the right questions, as is good trading.
So let's switch topics from it. So our rankings white paper from RCM that by the time this launches will either have just come out or will shortly come out. You guys are ranked. We show the top 5 in all these categories. So you're in the top 5 of best risk control, essentially.
Yeah.
Right. And I think, so talk to us a little bit about how you actually do that. Because everyone says they can control drawdowns. You guys have actually done it over the long term.
Yeah.
Flip side, I could argue you've done it by keeping vol super low. So just talk through that of how you view risk control, how you view your, I think the drawdowns under 5% historically, right? Which is unheard of in the managed future space.
Absolutely. So our max drawdown, Jeff, is 4.4%. It's important to look at drawdown as a percentage of the volatility you're running the fund at, right? So if you're running a 2 vol and your max drawdown is 4.4%, I don't think it's really all that attractive. But for us, in our example, if we're running, let's say, a 6 vol, and let's say in our 6 to 7 vol and our drawdown is 4.4%, then as a percentage of volatility, if our max drawdown is about, let's say, about half of our annual vol, that puts us pretty much, from a downside deviation perspective, we're pretty much, right at the top of the list in CTAs. I guess the second question you had was, how do we do it, right?
Yeah.
Yeah, that's obviously a huge, huge topic, and it kind of boils down to all the work we've done over the years, the back testing infrastructure, right, which allows us to test ideas which other people can't, or can do it in a very difficult way. That helps us a lot. Our approach is very different in the sense that we break down the market into different regimes, and we have a whole army of strategies which makes money in each respective regime. So when we think about risk, we obviously think about magnitude of drawdown, right? But another key piece of the puzzle here, which is not talked about enough in my mind, which is something we really focus on, is duration of drawdown.
Yeah.
Right. When we talk about risk management, there's 2 key components. magnitude of drawdown, right? So our max drawdown is 4.4%, right? The second thing though is duration of drawdown, which is, in my view, equally as important,
Yeah.
right? So in our case, look, we've hit new high watermarks every year, right? And it goes back to our approach again of wanting to be the best at what we do. So how do you produce the highest compounded returns in the long run? Well, it's pretty simple mathematically. The first thing you do is you minimize drawdown, right? Right. Look, if you lose 20%, right, you have to make 25% just to get
Yeah.
full, right? So if you want to produce the greatest compounded returns in the long run, step number one is just minimize drawdowns, right? Which is, again, sounds common sense, but it's something I walk people through just mathematically to really understand this concept, right? Is how lethal and how detrimental drawdowns are to your long-term return stream, right? And so that's kind of, that when I talk about being the best at what we do, minimizing drawdown is really one of the big pieces of that. So we have very, very strict risk controls across all of our trades. If any of our trades loses 30 basis points, we're out immediately. We have really, really strict risk stops across all of our strategies and all the markets we trade, whereby if any market loses 100 basis points, that entire market's liquidated and it can't trade until the next business day, for example.
So you mean like not if crude oil is down 1%, you get out of all crude oil trades, if all of your signals inside of that market lose 100 basis points?
Correct. So
Yeah,
if crude oil, hypothetically, if we lose 100 basis points at any time throughout the trading day, right? And all these markets almost trade 24 hours a day, then we completely liquidate that market. So our models can't trade crude oil at all until next business day.
All right. Okay. So it's absent the signals, no matter if you're making money in that trade or losing money.
No, we have to be losing money. So if we've lost more than 100 basis points in crude oil at any time throughout
across
the day,
multiple signals, got it.
Right, at a portfolio level.
Yeah.
Then we liquidate all of our crude oil signals, and we can't trade until the next business day.
How do you think about that? Because that can be a trap, right? If you always are locking in that loss, but you might not ever get the gains to outsize the losses that you locked in. I can't remember the name of the firm. It's since out of business, but they had this whole complex system of and basically they figured out they were just locking in losses. Right. And it caused this downward sloping equity curve of we just continually quickly lock in losses. Yeah. So how do you avoid that trap?
Look, you have to back test it, is all I can say. I mean, for us, we back tested everything very rigorously. So in our case, also, all of our strategies, we have about 32 of them, they all have a statistically significant positive skew. So it makes sense for our type of trading to have this type of risk control. Because look, I mean, if I put a trade on, this model's put a trade on, let's say right now, right? And let's suppose the trade goes south, meaning we buy crude oil, and the market immediately starts moving against us, so crude oil goes straight down. We know that trade is most likely going to end up as a losing trade. Because generally speaking, our good trades, Jeff, they're going to start working almost immediately.
Yeah.
And we've done all that research and done that analysis. So we know that, look, if we're losing 100 basis points across all these signals in crude oil, then you know what? That's going to end. Those trades are all going to end badly.
Right. Maybe 1 out of 10 or 1 out of 100 times there's this huge reversal and you made money, but you're saying across on average, it's a bad day.
Right. And so again, this boils down to our style of trading, which is very different than the rest of CTAs, because we have a statistically significant positive skew in our daily return stream, which logically you would think that, for example, trend following would have that, but it doesn't, right? I mean, the data doesn't lie, right? So because we have that, the one other really nice thing about this type of trading, Jeff, is that we can cut our losses very aggressively, and that actually increases our risk-adjusted return. It doesn't decrease it.
And talk a little bit about skew and what you said, because I would argue most trend following does have positive skew. Maybe it's just the ones that I like. Um, and I'll tie this back to when I was thinking about it, your mandate of like, hey, we want to have the best risk adjusted return. Like I could create some option selling program and get lucky on the timing and have for sure the best risk adjusted return, right? Essentially no losses, huge Sharpe ratio, because the risk is hidden. It hasn't hit yet. So two part of there, like first explain skew, and that would be negative skew because eventually you're going to have the big loss, right? And it's going to skew it the other way. But explain how you think about skew, because I think it's a little bit different from your math background. Yeah,
absolutely. So, anyone can look up the formula for skew online. It basically means, look, your best case scenario is better than your worst case scenario, right? Like your best trades are better than your worst trades.
That's a great, never heard it put so simply. I like it. Yeah.
Yeah. I mean, look, a lot of these statistics, I like to look, you have to just glean the essence of it, right? I think we were talking, Jeff, you and I offline about this, is that a lot of these statistics, like skew is an excellent example, was composed by individuals who were definitely not working in the finance space, right? The statistics were composed to help describe the natural world, biological world, right? It was not created to help us be better investors. So it's important to understand the essence behind the statistics. And the one we do is we create our own statistics, which reflects the underlying theme of what we're trying to capture. So if you look at the ratio of the best month to the worst month of a manager, that in essence is skew from an investment practitioner's perspective, which is far more meaningful than the mathematical skew. So let me give you an example, right? Our skew of our daily returns is, I think plus 1.6, something around there, and it's statistically significant. Let's say someone else's skew is, 0.2.
Yeah.
Those numbers, which I mentioned, 1.6 skew versus 0.2 skew, it doesn't have any real meaning attached to it, right? But if I tell you, hey, look, Jeff, our best month, is about 3 times our worst month, you understand that immediately. Yeah. Anyone can understand that. You don't need to have a math background to understand that, right? And so now we're really getting at the essence of why skew is so important, which is that, look, your best trades are better than your worst trades, right? Which intuitively should be the case. But look, we all have access to databases. Just do the analysis, right? I mean, how many firms, especially when you look at the daily returns, then it gets really interesting, right? I mean, Jeff, look at the SocGen CTA index, right? Look at the daily returns. Do you know what the skew of the SocGen CTA index is? Daily returns, or the SocGen STTI index?
I do not off the top of my head. Thanks for putting me on the spot.
Sorry, that's my job.
No, hit it. Yeah.
Okay, well, I'll tell you. So I don't remember myself what the number is, but it has a statistically significant negative skew of daily returns. Both the SocGen CTA index and the SocGen STTI index have a statistically significant negative skew of daily returns.
But not on a monthly basis? Or it's even on a monthly basis, roughly?
We don't really look. I don't know off the top of my head if it has it on a monthly basis. I'd have to check that.
Yeah.
We do all of our analysis using daily returns, just because, look, you have the sample size is so much larger, right?
Yeah. But that's interesting in and of itself, there, right? Like that you could have, it could be negative on a daily basis and positive on a monthly basis, perhaps.
Usually it doesn't happen like that.
Yeah.
It may be negative on a daily basis and kind of slightly negative on a monthly basis, or even neutral. It's not going to change. It's kind of like looking at daily returns versus monthly returns. Right.
But part of me is that just a reflection of the markets take the, what is it, stairs up, elevator down. So even if you have risk control, you get some spikes down, you get stopped out immediately. So yeah, that would be my pro trend follower, pro SocGen CTA index defense of like, okay, but on a monthly basis, it's not that bad. And they're just at risk of some huge down spike days like last week.
Sure, absolutely. But as an investor, Jeff, you want to know that, right? I mean, you want to know that, hey, look, Jeff, look, put it this way, you want to invest in a CTA, right? By definition, there's some timing involved. You could invest today or tomorrow or next month or next year.
Yeah.
So to some extent, you have to time it. If a firm has negative skew, that timing problem becomes much harder. That's for sure, right? And I talked about minimizing drawdown and how important that is towards achieving a high long-term compounded return, right? The worst thing in the world, Jeff, that you want is, hey, look, you put your money into CTA today, and it immediately goes into a drawdown, right? Now, the interesting thing, Jeff, is that the SocGen STTI index, which is a short-term index, right?
Short-term traders index.
It's a whole bunch of short-term traders, right? Different short-term traders that all do different things, right? And that is a statistically significant negative skew as well. Just something to think about, right? Like I said, investing, it's all about asking the right questions.
So without knowing what's going on under each of those firms' black boxes, why do you think that is? What do you think they're doing that creates that profile? Massively, generally speaking.
Yeah, without me knowing, obviously, anything about what anyone else does, right? I don't, I have no idea. I can just explain to you what the data says, and I can clearly tell you what the data says and what it doesn't say. As to the why behind the data, hey, I'll let you, put your creative thinking brain cap on,
right,
and explain that, right?
Well, they don't use stops. Their risk isn't fixed. It's right. It's dynamic. All the above can create that.
Exactly. The stops aren't tight enough. They don't have stops at all. I can't say because we've always had a positive skew, and that's how all of our strategies have been designed. So that's,
and you'll if it's a strategy, the back test looks great, but it comes out as negative skew. It's out.
Absolutely, it's out.
And it has to be significant.
Tongue twister. It has to be, yes, the strategy level. So that's from a portfolio perspective, Jeff. I can't emphasize, based on our analysis, how important it is to have constituents of a portfolio which have a positive skew. So, for example, we did internal research which shows that if a manager has a worst month greater than the best month over the past 3 years, right? Which you just take a step back and think about this logically. That shouldn't happen, right? Like over 3 years, okay, you'll have good periods and bad periods.
Yeah.
Right? Shouldn't your best month be greater than your worst month?
You would think. It? Yeah.
Okay, so if your worst month's greater than your best,
unless you're an option seller, but yeah.
Right. But if your worst month is greater than your best month over the past 3 years, hey, look, I can just say as being a trader for all these years, there's something amiss, right? There's something amiss in your risk management, right? So we did a study using the Lipper hedge fund database, over 10,000 hedge funds, not just CTAs, long, short equity, global macro, everyone. And we said to ourselves, okay, look, if over the past 3 years, a hedge fund has a worst month greater than their best month over the past 3 years, what does that say about their drawdown over the next 3 years? And not surprisingly, what it said was those firms that have a worst month greater than their best month over the past 3 years, well, guess what? Over the next 3 years, statistically, they have a higher drawdown.
Than they had in the past, or higher than their peers?
Higher relative to average. Statistically,
yeah.
No, relative to the whole universe.
Got it.
Right. So if I had a universe of 10,000 hedge funds, right, then over the past 3 years, if I look at the worst month to best month, that ratio, and I rank all the hedge funds from 1 to 10,000 based on that one statistic of worst month to best month, right? And I say to myself, hey, look, the hedge funds that are at the bottom, or even the bottom 50%, right? What happens to those hedge funds over the next 3 years, right? How does their drawdown rank amongst those 10,000? Those hedge funds that are the worst month, greater than best month, over the past 3 years, statistically, have a much higher drawdown relative to the 10,000 hedge funds in the universe.
So let's talk a little bit about CTAs got smacked last week with all this SVB bank stuff. I don't think, should you say SVB bank? That's saying Silicon Valley Bank, but SVB, right? Rates crashed, bonds rallied, everyone was short bonds. So talk a little bit about, did you guys have a bad 2 days there along with everyone else? Was it quite different? And kind of how does, just explain that in terms of your model, how you viewed those 2 days of massive treasury action.
Yeah, no, we made a small amount of money over those 2 days. Again,
past performance not necessarily indicative of future results. I'll throw that in there.
Right. Yeah, I mean, look, what we do, we're not doing trend following, right? So we have a hard rule in our program that, like, look, we're not 200-day highs, 200-day lows, like we're not buying and sell them respectively, right? For many reasons for that, because again, the risk adjusted return of that trade is positive, but the alpha's slowly been kind of going down over the past 30 years, that we've tracked it.
Yeah.
So we don't do any trend following, right? So with that being said, yeah, it was, it was definitely, vol definitely expanded very rapidly, which that's the part that makes it a little more challenging on our end, because if vol kind of like, expands extremely rapidly, then position sizing, we obviously have modeled all this, but that can always be a little more challenging. With that being said, definitely it's positive for us, that's for sure, because anytime there's a expansion of fear, like real fear in the market, which when I talk about fear, I really talk about implied vols, not realized.
And not just in equities, across everything you're looking at.
Exactly. Yeah. Anytime you have an expansion in implied vols, that always, generally speaking, represents a good environment for us. So that's what you kind of saw a little bit. You saw that over the past couple of days.
And that moves you into those models that like that environment?
Right. Exactly.
Yeah. And how does that look? That's day to day. You're switching. These 14 are on the field. I think you have a sports analogy, right? But like, explain that of like, okay, we're now moved into this environment last Friday. Who's going on the field? Who's coming off the field?
Yeah, we have like a regime indicator whereby we classify the market into 4 different regimes: it's rising vol, falling vol, high vol, and low vol.
Each market?
No, overall, just overall.
Okay. Yeah.
Overall, very broadly speaking. And then we identify first and foremost what regime we're in based on a proprietary volatility indicator that we've come up with based on implied vols around the world. And then once you've identified which of these 4 regimes we're in, then basically we allocate kind of more to the strategies that do well in that regime and less to the strategies that kind of don't do as well, is how we approach it. So,
and out of 38, like how they're evenly split, there's 9-ish per bucket?
Correct. By design, we have approximately even split across all 4.
And so it'll always be like, what does that split look like? Is it ever everything in one bucket, or there's always some hanging around in the other buckets?
No, diversification. We will never shut off 3 of the buckets and just have one. That's not how you achieve a high risk adjusted return by any means.
Yeah, well then you're guessing, or you're not going to be able to react to the shifts quick enough.
Yes, exactly. Like, for example, a good example I always use is March 2020. Clearly, we all know what happened in March 2020, but then April 2020, guess what? The market had a huge rally.
Yeah.
Right. So you got to be able to switch regimes fairly rapidly, and that's what we did. So like in March, for example, we had an amazing month. We were up about close to 7%, well over 1 standard deviation. But then most importantly, in my opinion, in April, we also made money, right? Which is a totally different environment, because in April 2020, the market rallied very strongly. But again, a regime indicator, it switched, right?
So I was waiting for you to say like you're sending the 7-footers onto the floor, then you're pulling the small guards off, then you're putting the forwards back in.
Yeah, I mean, using a sports analogy, I mean, look, this is what any successful coach does, right? If you want to use a basketball analogy, that's exactly what they do, right? I mean, you identify what kind of regime or what kind of, where you are in the game, and then, you basically respond accordingly. And it's a calculated response. It's not an emotional reaction. It's something you've thought about ahead of time and you calculated it, right? So yes, Jeff, to your example, I mean, yeah, absolutely, right? I mean, look, I mean, you want to throw your 7 foot on there at a certain point in the game. very strategically, knowing that that's a 7-footer. Hey, he may not last the whole game. His endurance may not be the greatest. He may not be a good free throw shooter, but he's got other strengths. I mean, no player's perfect. Right?
Besides Michael Jordan, yeah.
I mean, he had weaknesses too, right? When he first started, the Pistons kind of like
beat him up. Yeah.
Yeah. I mean, hey, look, I don't advocate that, but I mean, their coach had a strategy and it worked. Let's be honest. I mean, he didn't win championships. Let's not forget, MJ didn't win championships until later on in his career.
Yeah. Really that was just my duty as a loyal Chicagoan to point out that Michael Jordan was perfect. What did we cover? What do you want to share with us that we didn't cover? Anything?
Yeah, I guess, one of the things I like talking about a lot, just kind of on a more fun note, is like, the strong parallels again between, championship sports teams and championship hedge funds. A while ago, back at Context last year, Derek Jeter was one of the guest speakers, right? I don't know if you were at Context, not this year, but the year before that.
I didn't see him, no.
Okay, well, Derek Jeter was there. This is down in Context, Miami. And he was talking about what it was like to lead the New York Yankees. And he was talking about all the challenges of leading that team. And I thought it was a great talk because he talked about how you had Hispanic speakers and you had non-Hispanic speakers. You know what? They didn't really get along with each other. Very interesting. And I thought to myself, being naive, I'm like, does it really matter? I mean,
right.
Honestly, if you can hit the ball really well, I mean, fine, you don't get along off the field. I mean, so what? Right. Yeah. But this is where, again, anyone that played competitive sports will know it always translates into on the field performance, always. Right. And so one thing he said was, what he did, Hispanic speakers, I guess the coach or general manager said, hey, look, you guys should learn English better. So you guys kind of all get along. And what Derek Jeter said as a leader? He said, hey, look, I actually want now the English speakers to learn Spanish better.
Yeah.
And that was actually the turning point right there, is when he as a leader said, hey, look, you know what? The English speakers, they should also learn Spanish. You can imagine it got huge resistance.
Yeah.
Right. But it was just a thought. This is a real commitment culture, right? At play here. And it's something, look, I strive for that within our own firm. Like, look, I will never ask my employees, Jeff, to do something which I would do myself, right? Whether that's cleaning data, getting a Starbucks latte, let's say a tall pike and a latte, right? I would never ask them to do something which I wouldn't do myself. Now, the reality is, like, it may not be efficient for me to do some of those things because time is very valuable. The whole idea is, like, I wouldn't ask them to do something which I'm not willing to do myself. And they can see that, right? They see that I'm committed to their kind of long-term growth, and long-term growth means different things for different people, right? Long-term growth for you may mean something very, very different than someone else within your firm, and that's okay, right? But the whole idea is that concept of long-term growth is something that is encouraged, and ultimately that leads to greater loyalty. And look, greater loyalty, it leads to results in the long run. That's for sure. I guess that's the only one quick story.
I'm still torn on that. Or you just sign a really expensive superstar player, right? Like you get Messi on your team and you're instantly better, even if he doesn't fit in with the culture whatsoever. Or you get, right? So there's those, but you see this in the basketball world right now. Like they try and build these super teams. Brooklyn miserably failed.
Yeah.
Right. We'll see Phoenix, what happens. But yeah, it's happening in real time in sports of like, can you just buy your way into it? Right. And other people would argue like, well, sure, the Yankees had the culture and Jeter did that, but they had the highest payroll and they did all the. Yeah. I just like to argue the other side of it a little bit, but yeah.
Sure. Well, hey, I can say like the 2004 USA Olympic team, they definitely had the highest payroll.
Yeah. But they won the gold, right?
No, they didn't. They won bronze.
Oh, well, so that wasn't the real dream team. That was the one before Jordan and everything.
Yeah, those guys won.
The one after them. Yeah. But they're still the most talented by far. But
the Los Angeles Lakers back in the early 2000s, they had Kobe and Shaq. I don't know if you remember, but they stopped winning championships at a certain point.
Right? Yeah.
Right.
Well, they get old.
Yeah.
Oh,
But yeah, I mean, I guess, I guess the one thing is like, going back to the sports analogies, they always say that defense wins championships. Have you heard this?
yeah.
Jeff, this famous saying amongst any,
Yep.
any coach always says this. There's literature debating it back and forth, right? But look, if you look at, let's go to baseball, the teams that generally win the World Series, any general manager will tell you, Jeff, that good pitching beats good hitting
Yeah.
any day, right? Basketball, if you look at interviews with Kobe Bryant, he said himself, he's like, look, we won because of our defense. He's like, offense, like I may not have the opportunities to score. You know what? Winning comes down to good defense. And soccer, you talked about Messi. Hey, you know what? Now they're doing soccer stats like soccer sabermetrics,
Yeah.
right? Where the team that has possession the most, they tend to win.
He usually wins.
Right. So look, in our field, it's no different, right? I mean, what does it mean to play good defense? It means to minimize drawdowns. That's really important. But what does it mean to have possession the majority of time? Like in soccer, those teams generally tend to win. It means staying above your high water mark, right? Because
Yeah.
then you're playing from a position of strength. You're not playing from a position of weakness anymore.
I was going to say, you don't want to have, like, I viewed it quickly as having possession being like having exposure. You want as low exposure as possible, right?
Right. But I mean, in soccer, for example,
Yeah.
right, whatever team has possession the majority of time statistically tends to win.
Yeah. Yeah.
Right. So what's the analogy in trading? Well, it's basically possession means like staying above your high watermark, because again, now you're in a position of strength, right? You're not trading from a position of weakness, right? That makes a big difference for sure.
I hear you. All right. Well, we'll see. Good luck to your Princeton Tigers. Have you adopted them? You're an MIT guy.
Yeah. Well, I guess my alma mater's basketball team likely will not be in March Madness for
Yes.
quite a while. So
Yeah.
I've adopted them, that's for sure. So,
Awesome. Well, thanks, Kapil. Tell everyone where they can find you. Can they get your tear sheets and everything when they go to your website?
it's not on our website for regulatory purposes, but they can just reach out to me directly.
Perfect.
Look, I'm on LinkedIn.
Yeah.
That's the best way. We have a
We'll put
website,
your-
obviously. There's a contact information form on our website where you can kind of reach out to us, and we just have to make sure that you pass the hurdles necessary for us to send you our.
Understood. We'll keep it going. Keep controlling that risk. And we'll talk to you soon.
Great. Thank you, Jeff. Thank you for
Thanks so
having me.
much. Yeah.
It's been a great
Thanks for
pleasure.
being here.
Yeah, take care.
Okay, that's it for the pod. Go check out the rankings. Thanks to Kapil for the fun chat. Thanks to Jeff Berger for producing and RCM for supporting. And we'll see you next week with Al. Peace.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.